Hello, John Richter here from Financial Mechanics, and welcome to this first episode in your T102 DCF valuation course, where we're just going to kick off with some basic concepts. And in particular, we're going to look at these two interrelated metrics, NPV or net present value and IRR, internal rate of return. And I'm going to use Excel on this episode to do most of my lecturing just to kick things off. But before I do that, I'd like to sort of talk quickly through what I've called here some dictionary definitions. Starting with NPV, which is simply defined as the sum of the period by period net cash flows brought back to a single specific date. And the two elements that we've got to kind of worry about here are defining net cash flows, or NCFs, and figuring out how we're going to do this discounting. So that's the sort of setup for our Excel demonstration coming up here in a couple minutes. The IRR is then directly connected with that net present value definition, since it's fundamentally defined as the discount rate necessary to get to an NPV of 0. So we've got to, in concept, guess at some sort of discount rate, which we'll get at this concept of discounting here in a few minutes, to get the NPV to 0. And the final point I'd like to make is that this IRR doesn't carry with it a financial definition. It only has meaning in a financial sense if you know what net cash flows are being assessed. What are you measuring the IRR of? And with that by way of quick preamble, I think we'll just hop over to Excel and see if we can demonstrate some of these concepts in a simple set of circumstances before we wade ourselves into the complexity of the financial model. So here we are with the solution case to the T101 course loaded to the temp sheet. And what I'm going to do in this episode is not drag ourselves into the particular questions of the case setting, but I'm going to use Excel a bit as a visual calculator just to demonstrate some concepts. And so what I'm going to do is set up a bit of a scratch sheet here, which I'm just going to label DCF. And crucially, what I'm going to do to kick things off is I'm going to get rid of any kind of sense that we've got specific dates. So I've gone and cleared that header out. And I'm going to go and kind of set up my own ruler here, as we normally do. Not very wide. Go out maybe 12, 13, 14 columns perhaps, just so I can use some fairly narrow width. And do one minus, or that minus 1 I should say, because I want a time 0 column here to be clear about this concept of 0, which we're going to get onto here in a minute. And I suppose this is model column, not even model, DCF column counter and DCF period number. And the kind of significance of that will be more obvious as we go forward. And let's see, let me go and delete columns out there. And we have DCF sheet, which you guys would say, John, we really should get a separate tab color for this because the time ruler here is very different. So how about a little demo red color? So clearly a key place we could start with discounted cash flow or DCF analysis is to look at the concept of a discount factor and sort of try to look at what's all sitting behind that. And one way to look at that I think is usually very intuitive is to consider some sort of period money in today's terms, or today's dollars, or today's euros, anything you want to say, where we'll do 10, which we can consider, I suppose, 10,000 euros. So just like we would do cost escalation, we typically have amounts, as you know from now or by now, of in today's money. To estimate what we might have in future money terms after it's been inflated we typically, of course, would do some sort of escalation factor, which I can start by hacking in. So I can say the 10 is as at here in column 0, and I need to think in terms of period inflation rate. So let me go ahead and get that explicit input in place. Okay, so there's no sense of physical time just yet. Everything is just in Excel columns or periods, which might be 4%, and that is per period, to be very clear about that. Let's see, I might as well take a copy of this fellow up here, hacking into 1, and then after that we would grow it by 1 plus the period rate of inflation. So you guys are all familiar with this. So this is just standard simple inflation compounding, which will have that typical profile across the width of what we have, which is a fairly straight line on the kind of narrow gauge that I have for this sheet. And that would then lead us to a inflated value in each period of this 10 of some sort of money in the day, or often referred to as nominal cash flows. Okay, so this could be money back to us, this could be money being spent, this could be anything. This is just money. So all I'm trying to do is indicate that we can of course inflate the 10 and get some sort of future value. And as well, what we could do is restrict the period of time over which we're looking at those cash flows, as we do in kind of a normal financial model, some sort of operating period. Here I'm just going to sort of say something simple like cash flow period. We'll get into more details here. I'm trying to be as generic as I can, where I'm just going to type in a quick flag and leave column 0 for today and expect that 1 period later we might be looking at our first cash flow. And often 10 is a good thing to work on. So there's 5, 6, 7, 8, 9, 10. 10 periods of return just kind of makes visual math a little bit easier to look at more often than not. So I expect to see 10 for that cash flow period. So what we're going to do is restrict this fellow. Again, I'm just kind of using Excel here as a lecture basis. And we will, of course, amend our formula to include the flag. And now I'm kind of spanning our cash flows over the period of time. So in nominal terms, I have 125,000 euros coming back. And clearly, over 10 periods, that would be just 100,000 euros if it were not for the inflation. So that is our nominal, meaning kind of money in the day, possibly nominal or future value cash flows of the 10,000 euros. Now, from this position, if we just pretended like we had no idea what the source of those nominal or future kind of value cash flows was, and we just paste valued, and I'll mark the whole row kind of light yellow here just to sort of indicate that that's what we've got here and it's all its glory. I'll even put a couple decimals on that. Perhaps it's smart to actually do a live total. But we have no idea what those inputs are. So I suppose you'd argue it look like something like this. And we could, from that position, come up with what they are in today's money by reversing the process that we went through and taking those numbers and divide them by the escalation factor. So I can take a copy of my previous link here and come up with what the economists would often call real cash flows, kind of in today's money, real or today's money cash flows, with A divided by B. Okay, so just reversing that process and having a look, and of course we'd expect to get 100,000 euros as we suggested before. Now, that process of dividing by an escalation factor is not typically how things are done, partly because factor by definition mathematically means something used in multiplication. Therefore, what happens effectively is that we calculate a factor which is the reciprocal of the escalation factor. There are different ways to do that. If I go back up here just to sort of as the genesis of the escalation factor to create a new fellow here with the same period inflation rate, the discount factor, start on the sort of same basis of having a 1 at the point in time you're saying the money is relevant. One way to do it is to simply divide by 1. You guys can work out the maths on that, but the reciprocal is effectively changing that multiplication into division, flipping and dividing by 1 plus the period rate. And that gets us a discount factor, which does nothing else except kind of change the terminology here, where we now multiply by the discount factor. And I'll just finish that up. Of course, I need to change that. Hardly worth editing that formula. Okay, so from a lecture perspective, that should get us to precisely the same position. And there we have an introduction to the fundamental connection between the concepts of inflation in discounting in some sense with just different terminology. So I'll go ahead and clean things up here a little bit. And let's see, let's move the flag up to kind of our foundation area up here. And from a terminology perspective as well, I need to think about the fact that this is no longer the period inflation rate, this is the period discount rate. So you can see the parallelism between inflation or escalation and discounting, where this concept here of real or today's money becomes present value of the cash flows. Okay, so nothing fundamentally different, just kind of tightening up the terminology that we have in place to this point in the lecture. So let's go ahead and clean that. And let's see, let's get this label a little bit sorted out. Present value, I'm sure I said without actually typing it properly. And last but not least, we could certainly make a point that the sum of PVs of future cash flows becomes an important number that deserves some prominence rather than just be there in the display total. We know that to be 100. All right. Now, from this sort of framework, what can we do? Well, one of the key things we can do is ask ourselves, what is this stream of cash flows that we've predicted here? And by that I mean these nominal future value cash flows that we're inflating at 4%. You know, what would you be prepared to pay for those cash flows? So that promise to pay over 10 periods this input stream of numbers. Okay, so one idea is that if you asked yourself that my price that I'm prepared to pay, or the investment amount, okay, so this is kind of a prospective investment amount, you had $100 lying around, I should say 100,000 euros lying around, so we'll get my SMU on here as well. What are your choices? Well, one is to hand to somebody and potentially get this money back, and another is just to simply hold on to it and see what you can do with it. So why don't we take a side trip effectively onto that second idea and see what we potentially could do with this money ourselves. And what I'm going to do now is use our corkscrew section down here, which has been sitting silently awaiting kind of alternative self-investment. You guys get what I'm up to here. And I suppose we could just set up for investment. Looks like I'm preloaded with that from earlier work. Saved me some typing. So here's an investment balance where I kick things off with an investment date flag, which of course will be, okay, this is a date or period flag. I suppose I should be faithful to my idea of not getting into dates just yet. That is the subject of another session. So let's go ahead and say we're going to invest 100,000 euros in my time zero. Now, let's does a few things for us. One, let's see, is to ask ourselves, what might happen to that $100 if I put it in. And that, a simple sort of purchased a CD or something like that would change from period inflation rate, period discount rate to a period interest rate. You guys are starting to say, man, these rates are all looking like they are very similar, kind of what might be going on, and they are certainly cross-related. If I had a period interest rate of 4%, I would get that money back at the end of each period based upon accumulating interest, based upon that opening balance, just as you know, and that would get me my investment interest return. Okay, so this would be the money back to me in the form of interest, on the basis that we are just labeling this because this is a bank account, for lack of a better idea. Now, that of course gets us to the next question, which is, when might I get my money back? Meaning, on the presumption that I'm paid this 4,000 euros every period, and that's paid out, it's not accumulated within the account, what then happens to the 100,000 euros that I put in? And of course, we're going to return that after 10 periods, and it's at this point where I think it might be useful to get our cash flow period flag replacing our original forecast period flag up here, so I can kind of see what's going on in the header a little bit better as I page on down back to the bottom of the screen. So the idea here is that I have a return or principal return, or return of principal, which we will get 100,000 euros back in 10 after getting interest for all those. So that will cause my fundamental principal balance to decline in that period. And of course, if I get that principal back, there's no longer any balance in my bank account, and I'll no longer attract interest, which is hopefully adding up to 10 periods of 4,000 euros or 40,000 euros. I suppose if we want to kind of keep that theme going here. And we need a row total here. Okay, so we've got our 100,000 back after 10 periods. And so we have two types of cash flow coming back. One is the interest that we got every period after the initial period, and the other was the principal return, which I can take a copy of. And that is total investment return cash flows. Okay, point here is not to worry about arcane terminology just yet, or otherwise specify labeling on these fellows, but clearly from this we get, in nominal terms, 140,000 euros back over time in some sort of profile, which of course is kind of that flat 4 and then 104 effectively. Now the question is, if this is my alternative investment where I can get an interest rate of 4% for the length of time of 10 periods, how does the value of this compare in current terms to the present value calculation that we looked at before with those nominal cash flows, that inflating 10? And one way to look at this is to consider that if I can make this deal, hand somebody 100 and get this 4% interest for 10 periods, and they get my 100 back, and then I think this has got comparable risk, that this deal is comparable to my other deal, then the time value of money becomes 4% per period. I kind of want to see that 4% back each period in some fashion, and therefore what we could do is use the same discount factor, because it was also set up as a 4% period rate. So if I take a look at that nominal cash flow back and go find my earlier discount factor and multiply to get the PVs of total return cash flows, A times B. Many of you guys know exactly what's going to happen here, or that we certainly hope is going to happen. If I do a display total on that, that would be good news. If we saw the 100, yes, good stuff. It looks like if I'm expecting that 4% is a good discount rate, a good risk rate on my money, that deal comes back to 100. And that, of course, is sum of PVs. And at this point, I think I'm going to start saving myself some time and do an ampersand. Some of the PVs. Now, where does this get us? Well, this gets us the fact that this total return coming from my bank balance is the same current value or present value as we had with this other stream of cash flows, which was very different. It was different in nominal terms, right? It was that 10 inflating that looked like this, as opposed to the nominal cash flows that we got here, which are my total investment return cash flows, which are kind of small and then spiking up. The row totals aren't the same. There's 140,000 euros worth of nominal return there, and only 125, I think it was, or thereabouts on the first example. But the current value, the present value of those two deals, those two alternative investments, are the same at 100,000. So there's 100,000 euros that we calculated there, and 100,000 euros here. So it looks like I would be indifferent between those two investments if I thought they were of comparable risk, that they both had the same interest stroke discount rate. And it's at this point that we can introduce the concept of net present value. If we've got a present value of the future cash flows, we don't know what we're going to pay for it, but let's just suppose our investment amount is 80. Okay, so now I've got 80 that I pay for it, so that's obviously a good deal. Okay, and this is kind of my alternative, just to make that clear, alternative investment down there. If I only pay 80 and I get value back of 100, the net present value is 20. By that, netting off your initial balance, I should say your initial investment amount, which to this point we're assuming is the same date as the valuation date and the equity investment date. We are presuming for simplicity to this point are the same dates. So that becomes my net present value. That thing is worth 20, and of course if you just pay the 100 where you're neutral, you'll have a net present value of 0. And that's the sort of cross connect now between a few different concepts. One concept was the cross connect between the idea of inflating current money to get future money, i.e. nominal cash flows, as distinct from the reciprocal, which was discounting back. And the other concept that we had here is an approach where we looked at comparable investments, and that we kind of showed the connection between that discount rate and an interest rate you might get on a bank balance, and made a very clear, explicit item there. And I suppose the third feature that we've noticed from what we did here is that we seem to have either explicitly or implicitly in these investments a separation between principal return and some sort of investment interest return, or an amount above and beyond the principal that seems to be tied in to the rate of return requirement. Okay, so just as we have on a debt balance with interest and principal, we seem to have that concept with our investments as well, and that must somehow be embedded within these cash flows here that we have nominal future value cash flows. Must somehow be a separation between principal investment return there, and we'll get on to that later. So next and finally on this introduction kind of script, we need to kind of tie all this together with internal rate of return, or IRR, as we've already talked about. We know what the dictionary definition is, which is the discount rate required to get a net present value of 0. So we can actually apply that to the circumstances that we have here using Excel Goal Seek, because here's our net present value. We got a net present value of 20 if we only paid 80. So the question now is, what kind of rate of discounting would be associated now with an NPV of 0 if I only paid 80? And we can do Tools, Goal Seek, setting the net present value to 0 by iterating or changing the period discount rate, because that's the definition of the IRR. And we rock and roll on that, and we get 8.45%. We'll talk more about sort of variations on the theme there, but there I iterated, and I'll make it tan just to indicate that it's got lots of decimals, and it was sort of derived by Excel, of 8.45%. And that is the IRR. The IRR is the period discount rate required to get the net present value to 0. The question, though, then becomes, can I get at this number a little more conveniently than goal seeking? You know, nobody wants to do that in their model. So let me just sort of set up a internal rate of return section here, kind of moving from our discount factors and NPV to IRR. And what, of course, we can do is use the inbuilt Excel functions in this case to take a look at the nominal return cash flows. Okay, so I'll go ahead and link to our inputs for now. So I just have these in one place. So that's the money coming back. The money in is the 80 at some sort of investment date. So just to sort of tie it in with the concept we had earlier of flags, I can take this, and we're saying the investment amount is 80. Obviously, we've got a lot of repeated and mislocated inputs we can work on cleaning up, but this is the investment amount. Obviously placed in time as opposed to the input. My idea here is if I kind of move this flag around, I can kind of get my model to work a little bit better than if I just hardwire everything. So that's my sort of thinking going forward. So here I've invested 80 currently at time 0 where we've got that 1. And the nominal net cash flows is what we get back minus what we had to put in. You know, what did you have to pay to play the game? So that's what we put in. And that gets us this sort of classic sign convention you see from an investor's perspective, which is the good news, the positive numbers, money back, and the bad news is what you paid to play the game. From a nominal basis, you kind of got an extra amount of money back of 45 under this scenario. And the IRR of the nominal net cash flows is, in fact, calculatable with the IRR function. Okay, this will get us the period discount rate required to get that to 0. Now, we hope, and maybe I should get everything on my screen here if I can, fit it. Almost, yes, I think I can. We hope that when I do a percent style on that, that we get 8.45, and that the resolution of Excel's own inbuilt iteration is very similar to the goal seek, certainly similar enough for our purposes. You guys get the idea here. What do we have? A little bit of difference, 98, 448, 5332, 448, 598. You can sort of see some variation at some sort of decimalization that relates to the different approaches that Excel took. But 4486 and 4485, I think, sort of points that out. And from a commercial perspective, that significance is rarely material. So that is an explicit derivation of the IRR and the cross-connect to its definition, because that is more expedient. But to this point, you'll note that we did not use the NPV function. And if anybody thinks that the NPV function is a good idea or superior, we will let you tune in to some additional resources on that. But you can see that there's a difference in the enthusiasm you might have to periodically use the IRR function, which saves us from the goal seek, and any expectation that we need to use Excel's NPV function. With that quick introduction, I suppose the only final demonstration point that might be interesting is to take a look at the IRR of these other cash flows. Now, this bank balance here was giving us total returns here against an investment amount equal to the 100 at 1. So let me go ahead and put that in place. Okay, so there's 100 invested at that point, so that is going to be my investment cash flow. A times B. And the idea I've got here is to test the IRR of what you might call the net investment cash flows, the net debt cash flows. It kind of depends on what this instrument is. So I'm just repeating what we did before, and you guys can kind of intuit perhaps that we expect to see 4%. And it's just called something different. So this is the net bank balance, just to be clear, cash flows. You know, from your perspective, you get the money back, but you had to put the 100 in, and I am measuring a different total of increase. And let's see, I can actually copy. Yes, we did a nice fellow up there. So here's the IRR of net bank balance cash flows, 4%. That is the yield calculation on this bank balance, which equals the interest rate to the extent that the money you put in is still the current market value. And that's another cross connect between IRR and some of these other terms that you see. And that's a pretty good quick introduction to NPV, obviously starting with the discount factor, and IRR, the cross connect between these different rates, without yet getting into the complexity associated with Excel date logic. Everything to this point has been on this unitized non-dimensional time axis that we have, periods effectively 0 through 10. And with that, I think we'll just call it quits on this first episode. Good stopping place, and we'll pick up from here next time. Bye for now.